that monetary policy sets the short-term interest rate. This policy rule, if you look at it upside down, looks just like a Taylor rule. I wrote it upside down because it's analytically convenient, but you should understand that this is exactly the Taylor rule. So when alpha is bigger than 1, we're going to have the Taylor principal holding. Anytime inflation is above target, pi star, the nominal interest rate is going to be above its steady state value. I also added a little shock here, this epsilon t, which is just a temporary deviation from pure inflation targeting. I'm going to take this shock to be IID, again, just for simplification. But this should be understood as anytime monetary policy sets the interest rate in some fashion that isn't simply a reaction to inflation. So a positive epsilon is expansionary monetary policy. And whenever alpha is bigger than 1, you get the usual mechanism that if inflation is above target, then monetary policy raises the nominal interest rate to try to bring inflation back to target. And alpha bigger than 1 means that the nominal rate responds more than 1-for-1 to inflation, and that's the so-called Taylor principle. So this is kind of in simplified form, the canonical, excuse me, canonical inflation targeting model. Now, what does fiscal policy do? Well, it's going to set the primary surplus, and it's going to set it according to whatever deviations of the real market value of debt are from some target. So the target is B star, and this object here is the real market value of debt at the beginning of time t. So what this says is anytime debt is above its target, the central bank is going to raise the surplus, which then brings debt back to target. Okay, now in order for debt to be stable, this response of surpluses to debt has to be strong enough. And in particular, it's going to have to satisfy 2 conditions. One is it's going to have to service debt. So that means gamma is going to have to be at least equal to the real interest rate. And then if it's going to bring debt back to target, it has to retire a little bit of debt each period. So that puts in this requirement that gamma is bigger than R, the real interest rate, to stabilize debt. And so this is the kind of way that a lot of people think about fiscal behavior. Now, but you notice something really important here. This fiscal rule also involves a direct response to the price level whenever gamma is positive. Okay, so the price level sneaks in here. And so what this says is that a higher price level at T leads to lower surpluses, i.e. easier fiscal policy in the future. That is the key point that I want to make about fiscal backing. Okay, so now let's talk about one type of policy coordination. Remember I said there are 2 objectives. You've got to uniquely determine inflation, you have to stabilize debt. And it turns out that there are 2 different ways to do this. I'm going to focus on the way that most central banks think the world operates. And that's going to be one where we have a monetary policy that satisfies the Taylor principle, and we have a fiscal policy that returns debt to target. So this alpha is bigger than 1 and the gamma is bigger than R. But even in this inflation targeting regime, fiscal policy must support monetary policy. Okay, so how do we see that? Well, equilibrium inflation in this model, it just pops right out under that in this policy regime as saying that if there were no shock to monetary policy, then inflation would always be on target. Now, again, I could add lots of different shocks to this model, and it would just make things more confusing, but it wouldn't alter the message. So in this environment, a positive shock, meaning this epsilon going up, is a monetary expansion, and it raises inflation. Now, if you just stare at this solution for inflation, you can see that it involves the inflation target, pi star, it involves the monetary policy parameter, alpha, and it involves the monetary policy shock, epsilon. So these are all choices of the central bank. And so it's tempting to look at that equilibrium and say, inflation doesn't play any role, so it's irrelevant. Do not give in to this temptation. And now I'm going to explain why. Okay, so remember, the full equilibrium isn't just what's happening to inflation, it's also what's going to happen to government debt. And it requires that debt be stable. So now let's look at the debt dynamics. This shock that we're focusing on for monetary policy, again, keep in mind what we're doing here, going back to those first pictures, is we're looking at a case where the central bank is trying to raise inflation by lowering interest rates, okay? So that's a shock, that's what I just said is a positive shock to epsilon. Now, since this shock is purely transitory and bond prices depend on future interest rates and future expected inflation, this transitory shock is not going to have any effect on bond prices at the time of the shock. So now what we can do is we can just take that fiscal rule for surpluses, stick it into the government's budget identity, and then substitute in this solution for inflation, okay? And that gives us this expression, which is telling us how the market value, the real market value of government bond portfolio evolves over time. It's how the portfolio, this real market value at T, depends on that market value at T minus 1, but it also depends on inflation. And this is the solution for inflation. So what's happening here is that a monetary expansion raises inflation, but then it reduces the real value of debt service. So RB is the return, the nominal return on the bond portfolio. If you get a surprise increase in inflation, then the ex post return falls. So the real value of this government bond portfolio declines. And you'll notice that that effect is amplified when there's a lot of debt carried into the period. This is especially relevant now because our countries are all operating at higher levels of debt than they have historically. So these interactions that I'm talking about are bigger now than they have been, say, when government debt was at much more moderate levels. So what is going on here is that what the fiscal rule is doing is it's going to lower real surpluses because this value of government debt has fallen, okay? So just to review, we have a monetary expansion creates a surprise increase in inflation. That reduces interest, the real value of interest payments. That then reduces the market value of government debt. And because we have this surplus rule that says when the market value of debt falls, surpluses fall, future surpluses then decline. Okay, so now you don't have to think of this in this mechanical, in this sort of algebraic way. We could rely on what economists sometimes call supply and demand. So I'll give you this little supply and demand interpretation of this. the question that you want to ask is, when monetary policy takes these actions, what ensures that the bond market clears? Now, in most of our models, we just kind of uncritically apply Walras' law. And we don't ask this question at all. We just say, okay, well, the other markets have cleared, therefore the bond market must clear. And when we do that, we are putting implicit assumptions on fiscal behavior, the kinds of assumptions that I'm trying to be explicit about here. So in this model, the demand for bonds is really simple. Bonds are nominal, so demand is going to be homogeneous of degree 1 in the price level. Demand is decreasing in the bond price. But bonds, remember, are just like any asset. They derive their value from the discounted stream of cash flows. And that discounted stream of cash flows, in the case of government bonds, is primary surpluses. So we can write down this nominal demand for government bond portfolio as depending inversely on the price of bonds, positively on the price level, and then on also positively on the present value of primary surpluses. So this is the nominal demand for government bonds that pops out of this model. So let's suppose that the economy is initially in equilibrium at price level P0. A monetary expansion raises inflation just for one period. Okay, that's the thought experiment that we went through algebraically. Then the price level, since inflation goes up for one period and then returns to 0, the price level goes up and it stays up permanently. So in the bond market, we start with just supply and demand for bonds. And the equilibrium initially is P0, that's at point A. And then we do this monetary shock, and the price level jumps up to P1. The distance CD is excess demand for government bonds. So remember, the demand for bonds is homogeneous of degree 1 in the price level. If the price level jumps up permanently, and there's no shift in demand, no change in supply, then there's going to be excess demand for bonds. Okay? Now, what's happening here is, and it makes kind of good intuition that why there's an excess demand for government bonds. Monetary expansion reduces the value of bonds. If these expected cash flows, the surpluses, don't fall, then the goods cost of a bond has fallen, but the goods payoff, which is surpluses, is unchanged. That makes bonds very attractive as an investment. And individuals want to substitute out of goods and into bonds, which reduces aggregate demand for goods. So this is why what I was saying, that the bond market behavior is exactly counter to what monetary policy is trying to achieve with a lower interest rate, which is to raise aggregate demand. So what our models do is we resolve this conflict in the bond market with a convenient but completely untested assumption, which, going back to the algebra, says, okay, surpluses are going to respond to debt by more than the real interest rate. So then this lower value of debt reduces the expected present value of surpluses. And it turns out that if the present value of surpluses falls, then the demand for bonds is going to pivot back. It's going to decline, and it's going to decline by exactly enough to clear the bond market at that new higher price level. And this is the magic of Ricardian equivalence, which we build into almost every central bank model of monetary policy. So graphically, this just shifts the demand back by precisely enough so that the equilibrium is at point C, and that's consistent with that new higher price level. Okay, so this geometrically is just what I went through algebraically. Okay, so now the question is, have fiscal policies in Europe responded to monetary ease? Now, if you paid any attention, fiscal consolidations began as early as 2010, and they really kicked in after the sovereign debt troubles that hit. And so governments have adopted aggressive rules that aim primarily at reducing government debt and running primary surpluses. Now, of course, there are always some provisions that allow for counter-cyclical policy and so forth. But the critical thing to remember is these rules are designed to solve a political problem. And there is certainly legitimate reason for trying to solve that political problem. The problem is that they may inadvertently create economic problems. And that's the message I want to get across. So I'm going to skip this for now and move on to actually looking at the data. So here's the euro area. Remember, this is the same time period when the ECB was made interest rates negative to try to raise inflation. And if you look at the euro area as a whole, net lending, excluding interest payments, which is the primary surplus that I was talking about, is rising. And this is rising at the same time that interest payments have been declining. The theory that we just went through said if interest payments decline because the central bank is lowering interest rates, then you actually want net lending to decline. So it's going in the opposite direction. This is even more pronounced if you look at Germany. So you can see that they have been running substantial positive primary surpluses despite significant declines in interest payments. And the same is true of Sweden, which I won't show you, but it's also true in Switzerland. So these areas that I started out with by saying, gee, what's wrong with these pictures? Central banks are really aggressively trying to ease, and yet they can't get inflation up. In every one of those areas, we have a perverse response of fiscal policy to that monetary ease. And my belief is it's because there's this obsession with retiring debt. And I don't show you the debt pictures here, but in Switzerland and Sweden, debt as a share of GDP has just been steadily declining. Okay, so let me wrap up now. And I want to emphasize, I am not at all saying we need to abandon fiscal rules. But I think we need to design these rules with these monetary fiscal interactions in mind. And the statement I'm making is completely non-ideological. This is just, let's use some economic theory to design these rules. And there's no conflict between rules that stabilize debt at sensible levels and at the same time ensure fiscal backing for monetary policy. So I think there's no excuse for saying we got to solve the political problem no matter what happens with the economic problem. We can solve these things simultaneously. And the key lies in understanding how monetary and fiscal policies necessarily interact. And my last bullet point here, if you deny this fact, it's just religion, it's not science, is a stab at this mantra that come hell or high water, the only thing that fiscal policy ought to be doing is retiring debt. That seems to be a religious statement. It's especially pronounced in Europe, but I hear it in the United States from certain quarters as well. And I think that's a mistake. So that's pretty much all I have to say.
Eric, thank you very much for a wonderful presentation. I think you were able to present extremely complex topic with a really approachable language, and I think this presentation will be also extremely useful for policy making as well. I think there are very strong messages for European Union, and thank you very much actually for adjusting to our circumstances. We will have questions at the panel, and now I would like to invite Corrado to present about macroeconomic modeling in times of uncertainty.
Yes, so let me share the screen to see how that's going to happen. So hopefully, sorry, I'm just trying to see if it's happening. Let's see, so I can, do you see the slides? Or okay, great. Well, thanks, Eric, for indeed a very insightful presentation. So actually what I've decided to focus on is more of a policy perspective that summarizes both the work that is being carried out at the National Institute of Economic and Social Research, as well as some applications with respect to risk and uncertainty. So clearly, nowadays we are used, particularly with COVID-19, to hear that there is a lot of uncertainty, and clearly this uncertainty has to do not only with the nature of the shock. So COVID-19 as a health crisis is very unprecedented in terms of demand and supply side effects. And that is also because of the containment measures that many countries have implemented, but I'm not going to go through those. One of the biggest sources of uncertainty at the moment is the shape of the recovery, including the idea of scarring. That means that the first impression and the first reaction of policy institutions has been that of assuming a V-shaped recovery. But in fact, as we move into across time, clearly there is a sense that the scarring effect or the drag on the economy that this shock is going to have is probably going to be higher than expected. But that is clearly one other source of uncertainty. So the true and honest answer is that we don't know. And then coming together with the general state of health of the global economy is also the inflation outlook. It is very unclear to many whether we should expect inflation or deflation, or anyway, low inflation. And the sort of moving more towards medium to longer term. So what is the, how do we achieve that sustainability? Is there any role for international spillovers? And so on and so forth. So the questions clearly could go on forever. Now, what does it mean to model under uncertainty? Clearly, the type of models that we have at hand today are very different. I think that everyone would agree that when dealing with macroeconomic modeling, particularly in policy institutions, we need to be very aware of the assumptions we're making. Just a couple of days ago, there was a very interesting paper by two colleagues that were in fact suggesting that the only way we could get around a shock such as COVID-19 is that of indeed making quite important assumptions and try to motivate those. So clearly, the models can have more of a theoretical foundation, or they can sort of lean more towards empirics. So the idea that at least of the model that we have in house is that clearly, it's a model that relies on linkages and spillovers across countries, and that seems to be quite an important dimension nowadays, particularly if one looks at this previous box that has been produced by NISR. You could see that already the unweighted standard deviation of real GDP has decreased importantly over time, particularly from about the 50s to nowadays. And that integration of the global economy essentially means that in a situation such as COVID, which is, if you like, a common shock, even though the pace has been very different, means that there is very little space for countries to hedge risk. And that is precisely because of this, of the idea of economies becoming progressively more integrated over time. Now, so what is the model that we use in-house? So the model that we use in-house is a standard textbook, if you like, macroeconomic model, which relies on frictions, forward-looking consumption and investment. We have a standard monetary policy reaction function and long-run fiscal solvency rules. All countries are linked together by trade relationship mostly, but we do also have financial sector where assets and bond prices are explicitly modeled. So the idea is that having a standard toolbox puts policy institutions in quite a good place to play around with some key parameters and see how the model reacts and how the forecast changes subject to different calibration of the model itself. Of course, that also comes with limitations in the sense that to the extent that this shock represents, a sort of permanent supply-side shocks, henceforth, new equilibrium in the model, then models such as NIGEM, which are linear, would be very poor predictor, if you want, of what could happen in the case of sort of multiple equilibria or sort of non-linearities more generally. But now, if we go to what has been the result of the exercise, again from a policy perspective of the May forecast, one of the key takeaways was that the global GDP is expected to fall by about 3.5%, and as it stands, up until the previous forecast, the idea was that there was going to be quite a strong rebound. The inflation was temporarily revised lower because of oil prices, and quite an important component of the effect on the global economy was imputed to the presence of spillovers, in particular for small open economies. So according to some simulations that we've done in-house, small open economies are the one that have been mostly impacted by sort of global shocks as opposed to domestic shocks. Now, clearly, when we think about the output outlook for the next quarters, one thing to bear in mind is that the containment measures and so-called social distancing measures that have been implemented in most countries in 2020 Q1 will be eased gradually. The UK is actually one of the last countries to ease those measures. But there is a consensus that the overall effect of the pandemic is that of lower demand as well as supply, and generally lower productivity. Now, according to the calculations that we've done, the policy stimulus that includes both monetary and fiscal policy packages has played quite an important role in terms of softening the blow, meaning that these measures have cushioned about 2.5% of GDP overall. So the forecast that we have takes into account those measures that have, in a sense, helped the economies to smooth parts of the the shock and the sort of depth of the crisis. Now, why did we focus on uncertainty? Clearly, one of the important figures in the review, in the May review, is the graph on the left-hand side. So here we have annual GDP change compared to 2019. So one of the things that is quite evident is that there is a lot of heterogeneity across countries, particularly in terms of the rebound. But also, on the right side, you can see the global projection, and that global projection suggests that clearly there is quite a sizable downside risk to our forecast, and that downside risk essentially captures the fact that we don't know whether there will be, for instance, a second wave of the pandemic. We don't know really what the shape of the recovery will be, and so on and so forth. We don't know what the actual effects of some of the policies that have been implemented will play out. We don't know how people will adjust expectations and so on and so forth. So there are clearly some elements that are more obvious, such as that there is in terms of GDP, there is a level effect in terms of a one-off loss of in the service sector, but we don't know really the long-term consequences of these, simply because there is no real precedent, even though we can learn from previous episodes of pandemic. So this heterogeneity is explained by the fact that the economic policy response has been varied. That depends on structural factors. So if you take a country such as Italy, which is one of the countries that I cover at the National Institute, clearly the high reliance of a country such as Italy on the tourism and leisure industry is one of the factors that is expected to have quite an important dragging effect on the economy, particularly because those industries are the ones that in fact are being impacted by measures such as social distancing. Another point that is worth considering is that of the policy space. So Eric mentioned before the sort of the idea of European fiscal rules. Clearly, in Europe and in the Eurozone, more specifically, there is indeed a very strong case where, in the first place, the response, fiscal policy response of the different countries was guided by the nationally available fiscal space, such as that the response of Italy was, for instance, much smaller than that of Germany. That clearly because Italy has much lower fiscal space, and if you want also maybe credibility in terms of international financial markets, than Germany, for instance. So that fiscal space is clearly playing a very important role. But also is expected to play a very important role not only in the Eurozone, but also in emerging economies. So there has been quite a strong call across the board of both policymakers and academics to support emerging economies, because emerging economies have only recently started adopting inflation targeting. In some cases, they are, if you want, a bit beyond the curve, in the sense that they don't have the same fiscal policy space, but they also experience a very abrupt capital outflow. In fact, the portfolio outflow has been estimated of about 100 billion of US dollars in 2 months. So it's been quite substantial, and that has created a situation of sudden stops in these countries that clearly has made those countries worse off, on top of the falling commodity prices, commodities that these countries, the export of which those countries rely upon quite heavily in many instances. So the way essentially monetary policy has reacted was that of embarking into further monetary policy accommodation, including asset purchase programs. They did intervene in specific segments of financial markets, and there's also been a response in terms of microprudential as well as macroprudential tools. Now, as far as fiscal policy is concerned, that has translated into support programs to workers and firms. That, by definition, is going to create new deficit and debt. So the sustainability of debt is, in fact, one of the probably most compelling issues that policymakers will have to deal with sooner or later. So how to make debt levels sustainable. Now, I was talking about the fiscal policy space. So one of the important elements of the response is that despite the heterogeneity of the shock, we do see a case where the fiscal policy response has been synchronized, clearly because everyone was using fiscal policy stimulus, but largely uncoordinated. Also, the distribution between public expenditure and tax, as well as welfare policies, has changed across countries. But you can see, coming back to the point of comparing Italy and Germany. So Germany is the bar on the top left, whereas Italy is the third bar from the right. You can see that the response has been quite uneven, and that has prompted European policymakers to agree and in favor of a EU recovery plan that is now being discussed. But certainly in terms of managing the shock and managing the crisis, there's been an immediate call in terms of making sure that there was business continuity, and that would have to be reconciled with a longer-term objective. So as soon as the recovery phase will kick in, which will be that of debt management. So all those are elements of uncertainty, if you like, when we think about macroeconomic. So debt is indeed and will be, in our view, but I think in everyone's view, the issue. So how this new debt that we are creating is going to be paid off, and what is the debt distribution across the public and the private sector. So now the total debt is much higher in developed economy compared to emerging economies, and now the higher debt levels are observed in the corporate sectors. Household debt is generally not a concern in many countries, but clearly the fact that that we are observing a reduction of income creates a case where debt service will have to be thought through, and that would also link to the idea of how inflation will pan out over the next few years, because one could think that, in a sense, the current low inflation environment might help some countries to issue debt at a lower cost, if one has in mind the Fisher parity that Eric was talking about. But at the same time, so this, if we think about in nominal terms, but of course in real terms, higher inflation, having sort of medium-term inflation, which is closer to target, would indeed help erode some of the debt in real terms. So clearly, it's not at all certain what one should expect and what ideally the outcome should be. Okay, I'll skip the one on the spillover. So I just want to show a few applications of some work that we've been doing in-house on uncertainty, and particularly we focus on the UK economy. So one of the key issues is how do we quantify uncertainty. So one of the things that we've done was to start from the stock market data. So the stock market behavior has puzzled quite a few economists, in particular because there seemed to be a sense that financial markets are, if you allow me the term, excessively optimistic in terms of what the long-term drag on growth will be, because they've rebounded quite quickly. And so that was the main driver of our exercise. So we started by looking at the FTSE All-Share data for a high level of granularity. So we looked at 34 sectors, well, 35 sectors, which are actually the 35 sectors, including the FTSE All-Share. And then we bundled those 35 sectors into 11 macro sectors. And then we wanted to see essentially how different sectors have responded to the COVID shock, as well as whether we could single out some information out of this shock that we could use and we can learn from a policy point of view. So one of the first things we did was to run a risk-adjusted principal component analysis. So we essentially extracted out of these 34 sectors 3 principal components that we seeked to identify by means of matrix perturbation. So the 3 principal components that we identified were first a principal component, which is the blue one on the graph on the left-hand side, which is essentially an equal weight of the 34 sectors. So that's what we call the market. Then we identify a risk price factor, which is the yellow or light orange one, where essentially we assume a portfolio where investors would go long on the high mean return sectors and short on the low mean return sectors. So that's what we called risk price factor. And then the orange line, which is the one that basically drops the most, is what we call an uncertainty factor, because we assume is made of portfolio where investors go long on the high volatility sectors and short on the low volatility sectors. So once we identify those 3 principal components, we were quite surprised, but I mean, in rhetorical terms, maybe I should say, of the fact that the principal component that reacts more strongly to the what's been happening since essentially effectively the beginning of March in the UK was mainly the result of uncertainty. So we tend to think, and this is we believe also the consensus where the literature is sort of moving, even though we have a very sort of pragmatic and, if you want, policy-driven approach, is that COVID could, to a large extent, be identified as a demand shock, and I think everyone would agree with that, but also with an uncertainty shock, in the sense that it seemed to be the case where uncertainty component is a very important driver of the dynamic of what we have observed, for instance, in the stock market. So it is mainly the uncertainty that seems to be quite persistent. If you look at the market component, which is the blue one, or the risk one, you see that those tend to rebound much quicker than the third one, where in fact you have much larger persistence. And then out of this model, we also extracted some model implied volatility that unsurprisingly looks a lot like the VIX indicator. It is indeed interesting to see that the model implied volatility as extracted from asset prices does not suggest that there is a spike in uncertainty, if you like, the idea that volatility can be identified as uncertainty. There doesn't seem to be a case where there is very strong uncertainty after January 2020, at least not as much as we have observed during the global financial crisis starting from 2008. But it might well be the case that part of the uncertainty might reveal itself later on. And you can see also how the our measure of volatility also reacted to the news of the Brexit referendum in June 2016. So there seemed to be some information in financial markets that is relevant to policymakers, and that is broadly consistent with other indicators of uncertainty, such as Nick Bloom's indicator of uncertainty also doesn't seem to suggest that there is a high spike of uncertainty at the moment somehow. Now, clearly, the main interest for us was to understand how the different sectors relate to these different factors. And in V2, we do have the factor loadings, which are the betas, so suggesting how much each individual macro sector is related to what we have identified as an uncertainty factor. So you can see that essentially all the factors have a positive beta, or the majority of the factors have a positive beta, which means that those factors have been exposed to uncertainty. Whereas the factors that have a negative exposure to beta, in a sense, we claim those sectors have helped smooth the shock, are essentially consumer staples, which is anyway very small, but of course one should look at the how significantly different from zero those are. Telecoms, utilities, but most importantly the healthcare system. So we do seem to find that healthcare is one of the sectors that actually has had a positive impact from COVID, which is not crazy narrative if you think about the role of the UK in pharmaceutical sector, and similar effects have been observed in China for the healthcare sector itself. So there seems to be some sort of information there that is relevant to policymakers, and particularly if we were to draw policy conclusions and sort of sector interventions more specifically. And then the last thing that I want to talk about that closes the circle is the idea of term premia. So clearly, if we think about uncertainty, we should expect that mirroring a lot of uncertainty, financial markets would tend to price this uncertainty in, and that will naturally reflect into term premia. So that was clearly the case during the global financial crisis, where uncertainty came with higher premia, which, as you can see in the UK, US, and Germany, were quite high, around 3%. But it's interesting to observe that the term premia have been compressed over time, particularly in 2009 is the period that has been dubbed zero lower bound, where essentially monetary policy, at least in the US, has first exhausted the space for further conventional accommodation, and that has been followed by then countries such as the UK as well as the euro area. So we are now in a situation where the relationship between premia, so government bond premia, and uncertainty seem to have now flattened or even reversed, and a part of this explanation has to do with the role of monetary policy. So the idea that central banks have kept buying assets for a number of years now, more than 10 years in some cases, clearly does explain why term premia are now very close to zero, to the point that even they've exhausted any information content in terms of future inflation. So normally term premia and bond yields have been considered a good predictor of future expected inflation, but now having term premia close to zero as the result essentially of unconventional monetary policies as well as secular factors clearly seem to suggest that the information content as far as future inflation is concerned is quite flat, which is also concerning because it doesn't help to address these existing uncertainties. So, just for sake of being correct, one should mention that these observed behavior of term premia cannot be solely imputed to unconventional monetary policies. There's been quite a long trend of neutral rate sort of reference rates declining already starting from the 60s. So to some extent, those declining term premia could be related to the zero lower bound, but there's certainly more of a secular trend that has been going on for much longer than nominal interest rates hitting zero. And so what are the consequences of these? Clearly, that if one looks at the Fisher parity indeed, that seemed to suggest that episodes in which we'll be stuck at a zero lower bound will probably become more frequent. And that has prompted some work internally in terms of Japanization. So what is the likelihood that economies will become Japanized in terms of losing the inflation expectation anchor and being stuck in the sort of low inflation environment? But also there is a sense that prolonged episodes of quantitative easing might have diminishing returns, in the sense that financial markets might ultimately not be impressed after all about central banks buying assets. And so the different channels among which those unconventional policies are expected to exert an effect on yields might be exhausted, one of them being the signaling channel. So clearly the signaling channel is one of the channels that has been exhausted because QE does not represent a news, but we're also talking about a new normal even. And secondly, because now there is a very strong case for safe assets having become scarce, then we could think at a leverage reach for yield cycle where investors might want to move elsewhere. But again, financial flows and portfolio flows seem to suggest that those flows have been now flying away from emerging economies. So the next question is, where will capital be concentrated? Yeah, so in terms of Japanization, clearly those risks are very high for the euro area at the moment. We, based on some internal work that we've done, based on the Japanization index, we see that with all the due uncertainty due to the output gap estimates, the euro area has had quite a high risk of becoming Japanized, if you like the definition, particularly between 2012 and 2015, which is a period, as also Eric showed, where inflation expectation, headline inflation largely missed the targets in the Eurozone. But now they seem to be getting slowly out of that risk. But of course, this is subject to what the ECB next move will be and how financial markets will price in the new pandemic purchase asset program. So, as I said, clearly all those factors are tied together, and there are secular factors that are relevant here that we've heard a lot of, such as increasing propensity to save, reduction in propensity to invest, which are also factors that were present in Japan towards the late 80s. But also there's been a shift in demand and supply for different types of assets. So clearly, quantitative easing and scarcity of safe assets is going to play a very important role in the future. And the way these will be priced in by markets will matter quite a lot in terms of how capital markets will adjust, as well as how economies will adjust. So to conclude, and again, this was more of a overview from a policy perspective and sort of reflecting several discussions that we're having in-house. Uncertainty is a central part forecasting, and it's intrinsic to forecasting. But nowadays, of course, that uncertainty is quite big compared to what we have had previously, and the fact that now uncertainty and risk seem to now have changed the relationship among them, in the sense that there seems to be no relationship or even an inverse relationship that is completely different from what we have observed during the financial crisis. So part of this explanation clearly lies in the changing role of monetary policy, and to some extent also on the way monetary and fiscal policy will indeed interact, which will be more of a issue, I think, for the Eurozone more than other countries, mainly because of structural factors that Eric was talking about. So I would conclude here. So if you're interested in some of the issues that we discussed, so we have a review that is published by Cambridge University Press, so I should say, but I'll finish here.
Thank you very much, Corrado, for a very informative overview. I think we were able to see our present and a glimpse of our future as well. And I think we can say that both presentations are in a very same line in terms of conclusions, both theoretically and in terms of policy making. I would just, before we start with the panel, I would just make a couple of remarks. First, I have to welcome our friend and last year's speaker, Christian Popa, who is former vice president of European Investment Bank, former vice governor of Romanian Central Bank, and now in position of senior advisor to Vienna Initiative Steering Committee. Christian, thank you very much for joining us. We expect. We cannot hear you at the moment. Would you please check your equipment?
Can you hear me now?
Yes, thank you. So Christian will give a comment on your presentation, and after that we will proceed with questions. I think I have questions for 24 hours, but we will also, at the end, we will allow our audience attendees to ask questions as well. And first, Christian, please, the floor is yours.
Thank you very much. First of all, hello to you, Sasha, and thank you for the invitation to co-moderate this discussion. Hello to Eric and Corrado as well. I have a number of issues that build on both presentations, and I hope that they will be of comparable interest to both our previous speakers. The first observation would be that obviously the interaction between monetary policy and fiscal policy matters more than is usually obvious, either in, let's say, empirical terms or in the literature, pace a number of authors. But that being said, the way that the stylized, let's say, fact about fiscal policy is presented in Eric's paper, stabilizing debt levels, is, of course, of interest in itself. I think we also need to reflect a bit on the fact that fiscal policy is a complicated animal, not only in the fact that it mixes economic and political, let's say, dimensions, but in the fact that it has micro and macro components. It depends very much how you tax, what you tax exactly, how you spend. The composition of that spending divided between current and capital expenditure matters very much. And I would argue that expectations of the conduct of fiscal policy and expectations about possible reversals in the shares held by current and capital expenditure tend to matter to financial markets and to actors in the economy and beyond. The second issue I would like to possibly have your comments on would be, okay, what should we expect from the fiscal monetary policy nexus in a time of widespread unorthodox policy, let's say, stances, especially with asset purchases, with quantitative easing, and with the fact that with that, you have a phenomenon where central banks, especially the large ones issuing international reserve currencies, tend to also be market makers for certain types of financial securities. One other element would be, in a more particular focus, how fiscal policy would respond from QE to a possible move in certain, let's say, areas to yield curve control. We've seen this in Japan. It may be a temptation for other major central banks. And then two big things that I think matter. One is, once we get out of the closed economy setting, which obviously is rich in itself and easier to explore, into an open world setting, how do spillovers matter? Because you have spillovers, for example, from the implementation, as Eric argued some time ago, simultaneously of fiscal consolidation. You also may have, at this point in time, spillovers from large programs compared to previous experience of economic support from different countries, and within the EU, the start of what some analysts are calling a Hamilton moment. So it would be interesting to see that. It would be interesting to also explore the fact that we haven't touched upon the supply side nature of the present crisis determined by COVID. The fact that that impacts in a different way the ability of monetary policy versus fiscal to respond. It's not surprising that fiscal has center stage in the current process, especially in the damage control, let's say, moment we are getting closer, I hope, to the end of. But the idea is also, let's look at the material impact of the disruptions in global supply chains and how those impact the need for economic support in different countries or maybe regional. The fact that we've seen mainly uncoordinated policy responses, but I would argue that those policy responses were taken with an eye on what neighboring countries and countries in the peer group are doing at the same time. So there's a degree of, let's say, synchronization by imitation, if you will. But also, what's going to happen to two things? Corrado mentioned towards the end of the presentation that he expects low for long to basically intensify the peak to trough, the amplitude of global financial cycles and the intensity of the reach, he called it, I would say, hunt for yield. This would basically tell us that what we've just been through, at least temporarily, the outflow from emerging markets, which has stabilized in the meantime. We're seeing April and May as fairly good. There has been some yield differentiation, which you would expect, but not as much as the outflow from March would suggest. What will happen in future episodes? What can we expect? How can robustness and resilience be part of, or should they be, in terms of economic policy, dividing it into fiscal and monetary, and their simultaneous response? And what happens with an eventual process of making supply chains shorter and reshoring some activities along national frontiers, because then the macro risk becomes more national or regional focused. I don't think it's necessarily a game, because it would be accompanied by protectionism, but I'm stepping outside of my self-set bounds here. And the last thing would be, let's look a bit at what the intersection of fiscal and monetary going forward would mean when you look at the financial sector in more detail, and I would look at banks here in more detail. Banks are okay for now because they're better capitalized, they're more liquid, they have some forbearance from the regulators and supervisors in terms of using capital buffers, in terms of the liberty for a while to not move debtors who have opted for moratoria in terms of debt service payments into higher risk categories. But there might come a time where the forbearance from regulators is gradually being removed. Capital shortfalls need to be made up again. And the pressure of NPLs starting to build up from the fact that the private sector is affected by higher debt levels significantly and may be constrained by P&L positions, will not fail to make its mark on let's say, the viability of banks, or at least their ability to borrow and execute things in financial markets. So that's quite a rich perspective. Let's see what you want to react and think is valuable from those points. Thank you.
Thank you, Chris. Maybe as well as presentation, Eric and Corrado, would you comment?
Okay, I'm not sure exactly where to start. Let me talk a little bit about unorthodox policy actions and give a somewhat of a historical perspective on this. So I want to go back to the Great Depression and what Roosevelt did to get the US economy to recover from it. Because that's a great example of a series of highly unorthodox policies. So the first thing that he did was he went off the gold standard and eliminated convertibility of dollars to gold. This is akin to what's happening in the euro area, or what isn't happening in the euro area, because what he did was he took government debt, which initially was payable in gold, and converted it into genuinely nominal debt. And it was no longer a promise for gold, it was a promise for dollars. And he had control over the supply of dollars. Individual countries in the euro area, while they issue bonds in euros, they don't have control over the supply of euros. And so the situation is quite different. Then the second thing that he did, and this gets into talking about the role of expectations. Remember that the US had a 100-year history of having a fixed parity between the dollar and gold. And so when Roosevelt went off the gold standard, he had to convince people that he was facing an emergency and that he was going to do fiscal expansion financed by new government debt, and it would not be backed by future taxes. This was a big deal for him. And what he did was very clever. He split up the government budget into what he called emergency and ordinary. And he said, I'm going to balance the ordinary budget, but we're in a crisis, and I'm going to finance this emergency spending with fresh bonds, and I'm going to keep doing this until the economy recovers. So he had to shift expectations. And the way that he did that, and this gets into how do you anchor expectations the way that you need them to be anchored, is he made the stakes of economic recovery extremely high. He talked about how the US was in a worse crisis than World War I. He talked about how if we don't get the economy to recover, then there's a threat of dictators. And remember, in 1933, there was some other stuff going on in the world. And he could point to that other stuff and say, hey, look, that's what lies ahead if we don't do economic recovery. And by doing that, my view is he anchored expectations on the idea that he was going to do whatever it takes to generate economic recovery. And it turns out that expectations of inflation immediately started to rise. And as soon as he left the gold standard and started fiscal expansion, the economy began to recover. This, I think, is an important lesson for today. As I said, the euro area doesn't have this capacity at the present time. And the European Commission's recent proposal to kind of do some centralized spending, I think is off the mark. I don't believe it goes far enough, because it still doesn't create a separate fiscal institution in the euro area. And that's what you need in order to do the kind of economic recovery that Roosevelt did. So I don't know whether that actually answers all of your questions. It certainly doesn't answer all of your questions, But I'm trying to get across the idea that we need to take some bold action, at least on the fiscal side. We're seeing that on the monetary side. But my concern is that everyone's expectations on the fiscal side is, okay, there's going to be reversal. To me, this is the whole story of Japan. Japan's been doing a lot of expansion, and then they keep raising the consumption tax. So expectations are, okay, we're going to raise taxes. And fiscal expansion isn't terribly effective if everyone believes it's going to be followed by fiscal contraction. And so the final thing that I want to mention here, because this is germane to thinking about fiscal space, say in Italy and other countries, leading up to when he went off the gold standard, the government debt GNP ratio rose steadily. He then expanded fiscal policy, nominal debt more than doubled over the next 7 years. Debt GNP ratio was completely flat. So this perception that we have that there's always going to be this trade-off between doing fiscal expansion and maintaining sustainable debt policy, I think is a false choice. And it's a real choice right now for European countries because of the absence of a fiscal authority that is a sort of European-wide. But I think in principle, it's a false choice. So maybe I'll let Corrado talk now.
Well, thank you, Eric, and thanks, Christian, for the questions. Yeah, I mean, I think I'll so of course, among the many, very many points that Christian rightly made, I'll also start with the idea of an orthodox policy stance. I think if I have to echo what Eric just said, clearly for the Eurozone, there was a case where, quite interestingly so, countries seemed in the first place more prone or more willing to share risk through the European Central Bank than through sort of a third entity. In fact, you know, the very first response to the crisis was sort of an overnight change in Christine Lagarde's position from "we're not here to close spreads" to "well, we're actually putting a new program together to close the spreads." So that, I think, is quite telling in terms of how the Eurozone works, and the idea that, you know, debt is still a taboo in the Eurozone, even though, of course, it's been quite substantial change in terms of moving in the direction of a Euro recovery plan. But of course, that has, has always created the usual moral hazard discussion where you have frugal for on the one hand advocating in favor of responsible spending, and other countries that sort of want a no string attached approach. So I think this is probably very intrinsic to the Eurozone. But then if one looks at other countries, and I very much agree that there's no point in history where looking at Japan is more insightful than ever. I think the key question to me is, are those unorthodox policies really unorthodox nowadays? Because as I said, we've been doing essentially, so central banks have been buying sort of bonds for 10 years now. So I think the key question is whether those are really becoming the new normal. So whether we should expect from there sort of a move sort of away from the current sort of monetary policy toolkit. Some people have been advocating in favor of revising, for instance, the inflation target, so above 2%, and mainly in the light of the fact that clearly there are secular factors at play, but also because the forward guidance will soon otherwise exhaust its policy space. So I think that the question really is whether those unorthodox policies are in fact unorthodox nowadays. because one striking feature of the term premia findings that I was showing you before is that indeed, based on the information extracted from the bond markets, it does seem indeed that financial markets do not expect an inflation pickup. So that has remained broadly stable. Now, moving away from that, how we aware of what the sort of medium long run consequences of situations are. I think there are arguments to think that, for instance, the future will be more likely to be inflationary, I mean, medium term rather than deflationary. But there are also other arguments to think that the future might be deflationary. I think one of the key arguments that, Christian, you hinted upon for in order to expect inflation is the deglobalization. So in fact, there's been quite a substantial push in terms of reining in, and if you want, reconsider supply chains. And that has translated in many countries, so this push towards deglobalization has been manifested, if you think about it, in terms of the cross-border integration that has been substantially reduced at the moment, but also the process of offshoring is now very much limited, and that is sort of likely to put some sort of upward pressure on wages, because one of the factors that were sort of putting or preventing wages to increase, if you think about globalization, was the fact that clearly increasing global labor supply would in fact reduce the bargaining power of workers. And now all these factors seem to be less relevant, because of course I think the majority of countries' first reaction, also in light of the containment measures, has been that of sort of hardening the borders, but also the lack of competition now in the manufacturing sector, which previously could explain a decline in the cost of many consumer products, now is not. We're not sure whether this is going to be the case going forward, particularly as we will have to limit travels or trade. I mean, without wanting to go into that direction, and so again wanting to link to what Eric said, there are a lot of political arguments for strengthening borders. I mean, not that I support them, but clearly politicians have quite an easy play in pushing some populist argument, so to undo the web of relations that has made the world economy flourish post Bretton Woods. So a lot of there is quite a substantial populist thread in order to sort of deglobalize, but which I will not go there. But to move further, there are also arguments that there might well be deflation, Japan-style deflation, and one of the reasons being that clearly the direct stimulus, fiscal stimulus that we have considered in our presentation is clearly temporary and self-calibrating, meaning that once we enter the recovery phase, then those sort of stimulus packages will have to go back to normal. So if you think about the US, also the bulk of the US fiscal stimulus is temporary, and so the fiscal stance is set to be, if you like, massively contractionary as soon as the recovery will kick in. And that is, in my view, an argument for which we should expect deflation instead. So this to say that really the best answer that one could give in a policy institution, which is where I'm sitting at the moment, is that we generally don't know, but we do our best, so based on assumptions. And I think the MPL, I think I've sort of worked marginally on MPL in the past, and I think that that is also one of the key areas where I think everyone is really concerned. So non-performing loans, particularly in countries where GDP growth has been very sluggish. So again, I'm calling into question Italy, which was one of the countries that had staggering high levels of non-performing loans. So clearly those countries are very much exposed to raising levels of NPL, and I mean, against the backdrop of a European response, which is also quite muted and quite cautious in handling NPL, particularly as far as resolution is concerned. So clearly, all those factors are factors that policymakers will have to keep an eye on in the next few years. But subject to all of these, I think the key question would be to, as always, try to generate and invest in sort of growth enhancing sectors, and that sort of goes back to my sectoral analysis, because I think that's the key question in terms of making sure that that will be sustainable in the future, but also make sure that we don't end up in situations where we have sort of leverage and sort of domino effects of defaults as we observed during the financial crisis. So we don't enter again the trap of financial fragility, which is ultimately remained addressed, particularly unaddressed, particularly in Europe with an incomplete banking union and so on and so forth.
Thank you, Corrado. I have a bundle of questions, but before saying that I would like your optimally long answers, not saying short. So I would like to ask you a couple of questions, and then I also invite the audience to ask questions over chat, so we can later include them with audio, or we can read their questions. So if you have questions, you can start asking. One question I will just shortly elaborate. In March, Paul Krugman had a very influential article in New York Times about case for permanent stimulus. And I guess you all read it. So the idea is that the permanent stimulus of 2% of GDP would, directed to public investment, would actually be, let's say, free lunch for the society. So, and I think Eric's presentations pretty much goes in this direction. Could you all comment on this article and idea?
Yeah, actually, it's closely related to a point that I've tried to make. Central banks wring their hands over the fact that the inflation is below target, but in fact, I don't think people much care. Central bankers care. And so I have argued that, especially in some of these countries, Germany, I mentioned Sweden and Switzerland, long-term government bond yields are negative. That is literally a free lunch. You could sell bonds, stick the money under your mattress, and it would be a smart investment. But my point is that I think the best way to advocate for doing this is through infrastructure. And I think it could have the beneficial effect of also raising inflation to target. This is all pre-COVID point, right?
Yeah.
Right now, who knows what's going to happen? I think Corrado made that pretty clear, and he knows more than I do about what's going to happen. But I think that it's a crazy policy that a lot of European countries are running when people are willing to pay them to lend to them, and they say, no thanks, we actually want to borrow less. That is just prima facie evidence of bad fiscal policy. And so I fully support it.
Thank you.
Well, if I can sort of jump on these, I find very fascinating the idea of permanent stimulus, and I think also in terms of what does a permanent sort of fiscal stimulus imply for monetary policy, as Eric says, negative rates. So a few people have advocated in favor of sort of negative rates and unbound negative rates as an elegant solution to monetary policy. But of course, there are also arguments, such as in the UK, where the Treasury has started for the first time ever issuing bonds with negative yields. I believe it was on the 13th of May. And clearly that is an interesting experiment, because while countries such as Japan and the Euro area didn't have much options other than moving, in the case of the Eurozone, the ECB, the deposit facility into negative territory, and that was in order to enable the central bank to buy larger amounts of German bonds, which are the sort of safe assets by definition in the Eurozone. So because many of those were trading negative, so of course that enabled the ECB to do so. I think in the case of the UK, the potential trade-off and sort of the fact that negatively traded bonds might in fact constrain monetary policy from doing further stimulus, particularly in case where the central bank has a very strong preference against negative rates. So I think the issue of stimulus being permanent is, I think, something that's been discussed very much nowadays. I've read with great interest that Bloomberg reported, I think yesterday, the fact that Philip Lane was sort of opening to the possibility of helicopter money in whatever form that would be. But clearly that suggests that the debate is shifting in the direction, which is exactly the direction that Eric suggests with his model, where the complementarities between monetary and fiscal policy are going to become the norm. And in a sense, we should, at least ideologically, maybe relinquish on the idea of the central bank being truly independent. So accept the idea that in the current environment, that represents more of a fiction than a fact. And that clearly the secular factors that are at play do call for stimulus that is a bit more substantial. And as I said, even quantitative easing has been going on for 10 years now. So it is obviously a case where the central bank had no many options other than really buying government debt. So I think, to summarize, I think it's really a case where we should probably move away to the paradigm of sort of independent central bank and inflation targeting, and perhaps think that those complementarities are going to be the norm and need to be the norm if we want to have economies sort of going back to grow again and sort of escaping those factors that are very much structural.
Okay, Christian, what is your perspective from the central bank?
Well, a former central bank, obviously. I am quite uncomfortable, I must say, with the idea of what has been a de facto, let's say, temporary, I would hope, change in the way central bank independence is understood and functions, to a permanent, endless, let's say, change de jure in this regime. Now, the central bank doesn't just have a price stability mandate, although that is the overriding one. Increasingly, the financial stability and market functionality ones come into play. And we all know that it very much came to the fore with the global financial crisis, when the shift towards unorthodox policy measures and asset purchases and the balance sheet, let's say, channel of monetary policy started happening, that you could make a case interventions of this kind, even if systematic, if repeated by the central bank, served not only as a backstop, but also prevented a spiral in which obviously asset sales would increase yields and thereby delay, if not completely take economy recovery off the map of possibilities to one in which markets at least were understood as functioning. My question is, okay, we understand that central banks need to move in tandem here. Nobody's disputing that. In the current crisis, the idea of coming out and communicating a large front-loaded economic support plan, not just financial, was crucial to rebuilding confidence, because it's a confidence, let's say, crisis as much as one that affects both aggregate supply and demand. But to forever need to resort to more fiscal stimulus with the attendant accumulation of debt bought by the central bank seems to me to be unsustainable. At what point will we be reaching the limits of what is considered to be tolerable, acceptable? Obviously, we're not there yet, given the comments about negative yields, but I don't think that the route ahead is endless. So although I would hesitate in communicating any kind of, especially short-term kind of taper program at this point, I think it's highly inappropriate. I would not make any comments, if I were still a central banker, that this kind of support, this kind of intervention is endless and has no limits. I think those have costs in and of themselves. The second comment is that while we may wish for inflation at this point in time because it's noticeable by its absence, let's not forget that the increase in the aggregate price level a lot of the time hides some relative price changes. And in this case, with the reshoring discussion that I proposed and that Corrado kind of discussed more on, I think that what we aren't looking at is that while national or regional reconfigurations for shorter supply chains may be justified for reasons of resilience, robustness, or let's say security in things like healthcare, probably agri-food, essential supplies, energy perhaps, there is an overriding thing that openness and trade do bring, and that is efficiency. One of the reasons why we have very low levels of inflation, we've had them, call them whatever you like, the great moderation, or and they may be part of the reason for that real interest rate decline that Corrado showed us, although I would think that that's less long lasting than might be the case from seeing that graph. That's neither here nor there, is the fact that we have diversified and have taken full advantage so far with the attendant consequences on inequality and job losses, and especially advanced economies and some EMs higher up the value added chain. We have basically made use and have had lower prices for basic commodities and a lot of the things that go into the consumer price index. So reshoring will also mean that those prices will go up, and that, if you will, purchasing power levels will be affected, even if that may trigger a wage reaction that may lead to, as a side effect, the inflationary consequences we're missing right now. Let's not forget the distributional consequences. I think that that's of key importance. For emerging markets, since I've breached that kind of subject, it's important to realize that besides more limited fiscal space, you also have a question of the dependence on international, let's say, financial flows, the fact that they're not indifferent to their exchange rate positions. Depreciations may make them more competitive, but not always, because in some of them, and this is mainly the case with European emerging markets, you have fairly significant levels of currency substitution that are therefore cogent to changes, especially large changes over a short span of time in exchange rates. So that's the kind of view there. I would like to hear that this kind of joint effort of central banks supporting through asset purchases, I'm sorry, fiscal policy responses to a very difficult economic situation is going to be understood by everybody as being of a limited nature over time. Again, with the big debate on how to communicate this without scaring people into materializing in some responses into the present. So that's the kind of take I'm on right now. The second thing is, are we going to realistically expect that once you see distressed firms that have leverage that is no longer supported by their equity position, I'm not sure that the equity instruments that are available nationally or on a, let's say, European or international scale will be enough. Will we be seeing what is now not the case, but central bank purchases of corporate debt and possibly not just debt? That's a very loaded question. And I think I would argue that unless something dire and absolutely catastrophic arises, which I hope will very much not be the case, central banks will not cross that threshold. It's very difficult to see what a credible program of stepping back from where we are right now looks like, because the more political the process gets, the more difficult will it be to go back to the kind of independence we had. And as a final word, that independence was not a fashion, nor was it a byproduct of inflation targeting being, the flavor of the month. It was rooted on fairly important research and on the very nasty stagflation experience of the 70s that basically led central banks to thinking that the best contribution they could make to sustainable growth was to actually secure price stability and work towards that, even if it was in the limited kind of let's forget past mistakes way that inflation targeting could provide, and I think still might. Thank you.
Thank
Sasha,
you.
Sure.
To
something Christian said. I don't, first of all, I'm not sure that a permanent 2% increase in spending is the way we ought to be talking, okay? But I think we can all agree that substantial infrastructure investment is something almost all of our countries need. Having said that, I don't see that there's any necessary connection between doing the infrastructure spending and having the central bank buy those bonds. I go back again to the 1930s. For something like 7 years after Roosevelt took office, the Fed did 0 open market operations. If you look at the Fed's balance sheet, it didn't change from about 33 to 37 or even longer. And so what was happening was these were government bonds that were getting sold. The Fed was not buying them. The Fed did maintain low interest rates, which is exactly what central banks are now doing. So there's no necessary connection between, to my mind, between the proposal to do infrastructure spending that's financed with new government bonds and the loss of independence by central banks. The Fed can continue to do what it's planning to do with interest rate policy, and the government can go ahead and sell these bonds. That's pretty much what happened in the 1930s.
So thank you. My question actually follows the discussion. In sense, I was always puzzled, and I remember the period till 2008, that basically there was no discussion about any possibility of quantitative easing, and the independency of the central banks was sort of like a dogma, where basically it was very often considered that basically Minister of Finance and the governor shouldn't discuss any issues. And I just wonder, what's going on in institutions? What is your reflection and perspective, being academic and being inside of institutions? What makes the shift in line of thinking, and where we can see that the same institutions now are fairly stimulating economy and saying fairly lightly. So how do you see institutions in this kind of transition where we have completely different models of monetary fiscal interaction?
Should I say something? This actually gets to some of Christian's points about distributional consequences. What I think happened in part after 2008 was central banks were perceived as choosing winners and losers. And in the United States, at least, there's a section of the Federal Reserve Act called 13.3, which Bernanke used to justify many of the unorthodox actions that the Fed took. The response to that from Congress was to take that away. So now, many of the actions that the Fed is taking, it needs to get the Treasury's permission to do. That is in some sense undermining the independence of the central bank. But it's the law. And I think partly this was a reaction to the kind of populist response, which was, oh, central banks are helping the fat cats, and the public is getting nailed by it, by what's going on. So I'm not sure whether that's actually what you were getting at, but I think that was kind of the natural reaction. And one of the problems seems to be, this goes to the moral hazard point that was raised, and this is also relevant to what Corrado said, that after 2008, it seems that it's now a policy for central banks to intervene massively in financial markets. And in the United States, at least, it seems that every business is too big to fail. And in the Eurozone, every country is too big to fail. Bond prices don't really mean very much anymore because they all rely on the perception that the central bank is the lender of last resort or the buyer of last resort. So the old greater fool theory that I'm willing to buy a bond that pays negative yield now because, don't worry, I can always sell it to the central bank and I'll make a profit and the central bank will take the loss. So, but partly, if I want to defend central banks, which I'm happy to do, I think partly this is because our governments have not taken the kinds of policies that they need to take. And as a consequence, the central bank has stepped in and had to sort of take actions that they wouldn't otherwise take because fiscal authorities, I think, have been pretty irresponsible. And in Europe, it's a great example that the politics does not allow any sort of fiscal union. And so the sovereign debt problems that a lot of countries in Europe face end up having to get solved by the central bank. And it's not the central bank's job, but their job is to ensure stability, financial and otherwise. And if they don't take these actions, major problems arise.
Thank you.
Well, if I can follow up on that, and as well as what Christian and Eric said before, I think so. One issue that clearly we have to think about if we want to think about these monetary and fiscal policy interaction. I agree with Christian that clearly, the consensus among which sort of fiscal policy is and was in charge of sort of budgetary policy, and the central bank was in charge of inflation, is a consensus that's been built for a number of years. So clearly that is not something that is due to change overnight, and there is clearly a lot of inertia. As far as I could see, this is a discussion that has taken place more in policy circles than in the academic literature, in the sense there is a very strong resistance among academics, but probably Eric will be better positioned than me to, for instance, discuss widely proposals such as MMT. So that has been quite strongly rejected across the board. I mean, there have been few people that clearly have taken that seriously, but without going in the direction of MMT, which is sort of a very corner solution, even instances in which we think whether helicopter money, or instances in which the limit between monetary and fiscal policy becomes heavily blurred. I think, yeah, those are arguments that have been around policy circles for a while, and in particular, I guess, in the Eurozone, those are often advocated as sort of quick fix, if you want, to existing vulnerabilities and structural failures of the Eurozone itself. But I very much agree that this is not something that is due to change soon, because of course, in many instances, for instance, revising inflation targets will not be straightforward. Some instances in which the central bank independence might be de facto limited will require treaty changes. So it's not something that clearly we should expect to happen anytime soon. And probably a lot of the things that we will witness for the next few years will be if you want, quasi-fiscal policy through the monetary policy backdoor, which is essentially what happened, particularly in the Eurozone, I would say, where you had a lot of redistribution of liquidity and risk among European member states through quantitative easing purchasing program, asset purchase programs more widely, if one take also the security market program from 2010 even. So I think this is not something that is due to change overnight, but I think it's still healthy and useful to think whether this situation in which we are represents, say, a permanent sort of new equilibrium to policy, or we should expect to go back to the great moderation. I think the first reaction was that these sort of global financial crisis, even 2009, 8 and 9, was sort of a tail event, but now there is more and more of a consensus that there have been for a number of years structural factors at play. So I think it's legitimate to think whether this is in fact so thinking a 2% inflation target is still valid today, because we should not forget those are built on a consensus that was largely prevalent much earlier than now, so 25 years ago. So clearly, I think it's legitimate to discuss whether this still makes sense today if, say, interest rates are bound to remain close to zero, if inflation expectations are bound to remain below target, and if we have this saving investment mismatch. But I think the probably history will tell whether we'll move in that direction. But certainly the policy debate is quite, let's say, is more keen at the moment than what the actual literature is. So or the extent to which the actual literature is following up on those. I mean, at least looking at the number of papers published on these monetary and fiscal policy heavy interactions.
Christian?
Yes, thank you. I'm trying to sort of couch the argument further. There's a very interesting body of work that's quite recent from the BIS arguing for kind of broader brushstroke inflation targeting that doesn't just look at the inflation numbers per se, even in that kind of, let's say, cautiously worded way over the medium term, and if past mistakes in the sense of lower inflation than expected do arise, they do not need to be corrected immediately. As an aside, I did some work that was a while ago on the feasibility of nominal GDP targeting and price level targeting vis-a-vis inflation targeting, when you basically look at output stabilization, not just the achievement of your price stability objectives. And while they would look better than inflation targeting, both of the more advanced, if you will, regimes fail when you look at output stabilization. They also fail the Occam's razor, if you will, test of communication to the public, because you can only anchor expectations if the public really understands what you're doing. I believe that was part of Eric's arguments about 10 years ago about the science-y part of monetary policy, rather than the alchemical part of the fiscal. Now, that being said, let me sum up what the BIS was saying. They were saying something like we at the National Bank of Romania were saying in the period immediately preceding the global financial crisis and the run-up to our coming into the EU, which was at that time, we had to basically work on price stability. We were moving to inflation targeting, which we started in 2005, and we saw that massive inflows of foreign exchange, of capital flows that were used to basically on-lend in foreign currency in the country, were posing both an aggregate demand problem and a financial stability problem. So we basically argued for what would be now known as macro-pru, that was more a macroeconomic risk management perspective. This, I think, is a better way in which to couch any kind of amendment or possible thinking about a future policy regime for central banks. Now, that being said, my concern about a permanent stimulus of whatever nature and whatever it's spent on, I completely agree that infrastructure should be a concern, because we see a shortfall all over the EU. We see a similar one, if my numbers are correct, in the US, and those are not isolated places. It makes sense. The political process is naturally fragmented. How much can we count on voter accountability and on continuity in good governance in politics, that the 2% stimulus doesn't become 4%, doesn't become 8%, and doesn't start being spent on something else than actually meaningful infrastructure, and basically just becomes a free-form, shape-shifting kind of permanent stimulus that tends to be bigger and bigger, and that at some point in time, with markets less than fully cooperative and absorbing ever higher debt levels, I hear, for example, I'm entering into kind of a bizarre debate with a proposal made by Mario Draghi and the FT, I think about in early to mid-March, that it doesn't matter how big debt numbers and debt levels become, we need to have a no limits, whatever it takes Mark II fiscal response to the crisis, which in terms of possibly affecting expectations and building confidence was great, but you couldn't see a way out of it. Once you promised that and you started delivering, it was difficult. To what extent can we actually expect, and I'm now painting a scenario I wish I never will have to witness, an increasing direct or indirect interference of the political within the workings of the central bank with existing, let's say, appointments there, or increasingly political appointments at central banks. I hope we never go down that way. And I think that the consensus, what remains of it from the old days, which, as I said, is not irrelevant intellectually or from the experience point of view, will still prevent people from making huge leaps in what I believe is a very risky and possibly very wrong direction.
Thank you, Chris. Correct me if I'm wrong. I think you read some of the Michael Woodford's work. So I hope that he will also be one of our keynotes for the next year. At this point, I don't see questions from our audience, but I will ask you a last question for this panel. And like we saw, Corrado, in your presentation, you had, in my opinion, very optimistic world growth rates for the next year. It's 7%. And this kind of rebounds, I think it's really optimistic. And this is my questions for all of you. Do you think this is real? What are the fundamentals for such high level of growth? And also, being in Croatia, I would like to have your opinion on what kind of fiscal monetary policy would you recommend for a small open country with pegged exchange rate to euro, entering Eurozone. What would be your policy advice?
Okay, so I think I'll start with the 7%. So of course, this was the based on the work of the of the institute. So it was for the world economy based on the April and May exercise. So one striking features of the forecast during the previous quarter was that I think many policy institutions across the board were at first quite optimistic in terms of the shape of the recovery. In fact, as I said, the baseline for many of those institutions was a V-shaped recovery. But clearly, when we think about forecast, we have to think that the central baseline scenario is one of the possibilities, but clearly there are upside, and in this case, mainly downside risk to that number. So clearly, we've seen that some of those risks have materialized, and that materialized, for instance, in consumers' inflation expectation not having changed so much, but the sort of uncertainty, the dispersion of those to have increased by a large amount. So so part of the downside risk is really embodied by the increase in uncertainty that surrounds many aspects of the recovery. So, so this to say that, I mean, we as at NISR, as well as every other forecasting institution, including the IMF, and incidentally, a colleague just sent me a live stream from Geeta Gopinath on macroeconomic modeling uncertainty in uncertain times. So I'm glad that we sort of alienate on that point. But I think the idea is that as we enter the forecast, and that's also one of the points that the IMF is making, that would entail a substantial revision, unfortunately, of the numbers that we were previously having in mind for Q2. So this is part of the fact that as we move on deeper into the crisis, we do gather more information. But as I said, the major concern at the moment would that be uncertainty, which would certainly confirm some of the downward risks and some of the downward concern that we had in our previous forecast these materialize. So that's why it's not probably going to be 7%, unfortunately. But yeah, so we will enter the new forecast round actually in a week. So I think in July I'll make sure that the new forecast will be duly circulated among our viewers. And as far as Croatia is concerned and the sort of access to the monetary union, I'm not an expert of Croatia, I should say, but I think that of sort of twisting a bit your question, I think that of politics is, to me, the biggest challenge for new sort of EMU members or sort of prospective EMU member states, because ultimately not only the way of handling the crisis still revealed and confirmed some of the existing fragilities, and in particular the idiosyncrasy of the response in many ways, but also there is very much some elements that have not been taken into account, such as winners and losers from the financial crisis, redistributive issues inside the Eurozone, and ultimately the fact that countries that have signed to enter the EMU, they in the first place signed to join a currency union that, however, for its own survival, that currency union will not necessarily be a currency union, but will have to be a currency union with a banking union, and hopefully in the long term with a fiscal union, and best case scenario with a political union. So clearly that of politics and make sure that political interests become aligned as diversity and heterogeneity increase within the union is quite key. And that to me is the biggest challenge, both nationally, because of course we've seen, particularly in Southern Europe, as well as Northern Europe, the uprise of sort of non-mainstream parties that have jeopardized the political debate. So there will be a challenge both nationally, as well as I think at the European level.
Eric, thank you.
Well, mean reversion is a powerful force in our models. And from what I can see from the forecasts, not just that Corrado presented, but all the forecasts that I've seen, mean reversion seems to be winning the day. And I think what we need to acknowledge is that the type of uncertainty that we now face is very different than what we faced in 2008. We don't really understand yet what the nature of work is going to be. We don't know what effects that's going to have on labor productivity. We don't even know if schools are going to be able to operate. And so I think that if we had uncertainty bands that really reflected our ignorance, they would be massive. And now, of course, if the Institute produced such forecasts, they would be roundly ignored. And so out of self-preservation, in addition to mean reversion, nobody's going to produce such things. But I tend to be much more pessimistic than these forecasts seem to be. And that's in large part because I have so little confidence that our governments are going to respond sensibly. And here I'm not talking about central banks. In the United States, we can't, I don't think our central government is at all reliable. I think they're doing exactly the wrong thing in many ways. And this is a problem that by its nature is a central government problem. It's not a state and local government problem. And until we recognize that, I don't have much confidence that we're going to bounce back. In terms of Croatian policy, here I'm even more ignorant than Corrado. Clearly, if you're by pegging the exchange rate, you've already tied the hands of monetary policy, so there isn't a lot to discuss there. On the fiscal side, I guess I would go back to some of the things I was talking about in my address. I would be thinking about fiscal rules that are consistent both with the criteria that the EMU is setting, or EU, as well as thinking about the backing for monetary policy. I would also suggest that depending on the state of infrastructure, that the return to infrastructure investment can be sufficient to allow you to not have to worry about sustainability issues from those kinds of expenditures. And so, you know, as I think it was Christian who was worried about sort of spending creep from the permanent 2% budget, you definitely want to avoid that. And even if you're doing it on infrastructure, there's still that possibility. And I think the fiscal rules that you design would help with that. The last thing I would suggest, and this has been done in Slovenia, is the fiscal council there has developed models of the fiscal limit to try to get a sense of how high debt GDP can get before running into you know, sovereign risk problems. And I think having a suite of models of that sort can be extremely helpful for guiding fiscal choices going forward.
Thank you, Eric. While you were commenting, I had idea that we are actually doing macroeconomic modeling in the times of a huge black swan. So
yes,
Chris,
let me just say something about black swans. I was in New Zealand and I was walking around this lake and there was a huge flock of black swans. So that's the world we live in.
Very good point. Christian, please.
I noticed that there are 2 questions from the audience.
Yes, can you see those questions? Or I will read it. Chris, should I read these questions?
I think all of us can see them in the Q&A toolbar up at top up with where the Zoom application,
okay.
Right?
Okay,
They're direct to Corrado, if I'm not mistaken, from what I understood.
Okay. So first question is for Corrado.
Yes, so I was having a look at the question. So the first question is asking whether the lockdown will increase development in some sectors and usage of some services. So like telehealth and financial industry. Yes, I mean, I have to say that clearly the evidence suggests that the world, or economies have clearly gone digital, yeah, and this conference being an example. I think when we think about sort of changes in the way we consider economies, I think we should be worry of the fact that first of all that some of the measures that governments have adopted in order to contain the spread of the virus actually did in some sectors choked off production. In a sense, we have instances in which government interventions money seem to be chasing too few goods for the moment. That's definitely called for granular intervention, and particularly as the virus is really playing havoc with the supply of some products. The other sort of argument in favor of calling for target intervention is that a number of industries will clearly be less profitable once some form of ongoing social distance will limit the capacity in which they are allowed to operate. We mentioned, for instance, the hospitality industry. Examples are also restaurants and airlines. So we should think about how those sectors are going to continue, and the fact that in some cases those are low profit margin business models, particularly if you take sort of airlines. Now there is a lot of competition, and that means that in order for the sort of turnaround to be profitable, then it is likely that the price changes will sort of be following in order to keep those businesses alive. Now, in terms of the telehealth, I'm not by no means an expert on health, but certainly it looks as we are moving into that direction. But I wouldn't put my finger on it in the sense that, as I said, I haven't done enough work on sort of digital economy to predict that. If I have to base that comment on my own personal experience, then I think I would tend to say so. And then just to briefly touch on the second question, and I'll gladly pass to Eric. So the second question is whether essentially the fact that we are moving towards deglobalization, or at least there are incentives to do so, whether countries should ultimately focus on their own comparative advantages and as opposed to the previous globalized models. I think they shouldn't. I very much believe that globalization and the welfare that came with it, and post-Bretton Woods, so this web of relationship that brought economies together is and still remain a good thing in my own personal view. So I don't think by any means we should undo these. On the contrary, I think this would be a chance for sharing information in finding a vaccine and sort of make sure that technologies are available to fight this pandemic, which is ultimately a global health crisis. So my short answer is that we should not actually go back to we should sort of refrain from giving into the deglobalization trend. But I'm not sure this is going to happen. But that's what I wish.
Thank you, Corrado. And unfortunately, we have some more questions, but we need to wrap up our panel. I think we had really fantastic panel. I certainly enjoy. Corrado, Eric, thank you so much for your fantastic presentation. We hope that you will spill over your presentation to our journal, Proceedings of University of Rijeka, Journal of Economics and Business. We would really like to have you in our journal. I think your work is fundamental for the field and for the policy implementation as well. Christian, many thanks for your fantastic observations and comments. And I hope I see all of you next year in Opatija at our conference in live.